The main thing's really, I suppose, just in terms of helping you to become financially successful, is to start planning for what it is that you want to try and achieve financially, setting out clear financial goals, creating a budget, and then prioritizing them to ensure that you can achieve those goals and what we refer to something called financial independence. To start with, normally the building blocks for me are to set out what I call a menu board. What are your main focuses in that? Are you looking to save short term to buy a property, or are you looking to pay down debt, particularly given the fact that interest rates have risen quite significantly? And obviously, the cost of a mortgage, for example, is a lot more than it was 18 months ago. And once you can start to kind of pinpoint these, and again, through the use of an advisor, get your priorities right. Because a lot of what we do as advisors is provide the right balance. Yes, of course, it makes sense to consider paying off some of your mortgage, and a tracker has one advantage of allowing you to pay back monies early. However, if you're on a fixed term interest rate with your bank on a mortgage, and that say has another 2 years to expiry, and you're paying 2.5%, which were rates that were available a couple of years back, I wouldn't be as fixated about paying back the mortgage, and you may be restricted to how much of it you can pay back. And therefore, it's worth looking at other opportunities to get that money working a bit harder for you. Give us a sense of what you're trying to do. Like, is it that you're trying to save for your kids' third level education needs? Are you trying to become financially independent? It's funny, I see a lot of these videos talking about, retire at 50. And as much as it sounds great, there needs to be some sort of method behind this, and it's about trying to make sure that you put yourself in the best position you can. One of the main things that I think all of us should do, particularly in the month of January every year, is to fill in a financial budget calculator. It sounds mundane, but it's a really powerful tool, and it doesn't matter how much money you're earning, doesn't matter whether there's two incomes or one. But the key point is that you should have an understanding of what money is coming into the household and where it's being spent. There's a really good financial budget calculator on the Alpha Wealth website. It's completely free. It just have a nice little kind of chart that shows kind of how your spending patterns are. But what we do then is we try and help our clients save the appropriate amounts to help them to achieve their financial goals. So again, whether that's to retire early, whether it's to pay for a new car without having to get a loan, and making sure that you're in the best position possible. And again, I'm often asked, like, how much money should you save each month? And whilst it isn't an exact number for everyone, again, it depends on what stage you are in the financial cycle. But generally, I say you should be saving about 10% of your gross income into a pension scheme. You need to think about, where you're saving and for what purpose. So I've compartmentalized this into three time frames. Short term, which is typically 0 to 3 years, medium term, which is 3 years, up to this age of financial independence, which would vary depending on obviously how old you are and when realistically you may be in a position where you don't have to work. If your requirements are that you need to save money for the short term, let's say you're looking to buy a property in the next 2 years, your focus will have to be on short-term savings. And typically you are confined to secure accounts. You cannot take any risk over that time frame. And then it's a case of finding the best in class. Anyone who's saving monthly, and obviously if you are saving for something in the next 3 years, you should be trying to allocate a certain fixed sum. If you're saving for a deposit for a property, if you're saving to buy a car, it's a really good idea to have a regular payment going into a financial institution. The best account at the moment available in Ireland is an online saving account with AIB, currently paying 3% gross. The reality is that over the last 4 or 5 months, deposit rates have increased, and you can take advantage of that. There are accounts that are completely secure, earning currently around 4.1%, that are available through the German online banks. Now, I know that may sound a bit left field to some people, but Raisin Bank, which is a totally bona fide bank, regulated in the EU, with financial strength of better than the Irish banks, will give you 4.1% gross over 12 months. Now, the graphic I've just put on the screen here is just illustrating the point about why it's so important to earn interest on your savings. For someone who's saving €1,000 a month and is earning 3%, which I said you can earn with AIB online, versus 1%, which is typically as good as you would normally get in most of the banks, unless you go looking for these obviously better rates. And you can see here that over a 3-year period, the return for 2% net, if you get 3%, 1% of that goes to tax, which is 33%. You'll earn basically 37,000 and a half, 37,500 roughly over that 3 years. However, if you're only achieving 1% gross, which nets to about 0.67 annualized, you would lose about €1,000.